Great.
Regarding the structured value approach to buying into positions, how has the fund determined to best put a contract? How has the fund determined the best put contract durations and strike prices to maximize value across the four simplified outcomes that Matt outlined?
Wonderful. A lot of what we're explaining here is stated in a plain vanilla way. We have a really diverse audience, and so these are in some cases they're very real, but they're also plain vanilla. What we are really doing, because we have a larger pool of capital, we don't need to sell just one contract. We are building out a matrix. So we will sell contracts that have different strike prices. We will also sell contracts that have different expiration dates. Because of that, as we move through time, we typically find that we purchase some of the shares underlying the contracts that we've written, and others are above the strike price at expiration, and we don't buy those. What that does is it kind of further lowers our cost basis. It also allows us to sort of cost average in over time. So if we have contracts that are expiring every month for the next 12 months, generically, if there's a price of 10 and the price is oscillating around there, we're buying during the great opportunities and we're not buying when the shares are at 12, and we're keeping all of the premium. So what we do is we create a matrix, we figure out our total notional exposure that we'd like to have in that position, and we write out those contracts. And then incidentally, as those contracts expire, we then evaluate whether we took on the exposure or not, and we write further contracts. So we keep writing contracts until we get our full notional exposure. And it's quite attractive. I mean, if a price is volatile and flat, we actually do quite well, really bringing down the costs. I'm seeing some of these questions in the chat, so I'll just comment on it. Someone asked about, is it really possible to pick up $25 premiums on a $100 share? And shockingly, it's possible. It happens. It's not available every day. You have to be patient. But when there's a pandemic, when there's a flash crash, when an individual security, because this is not just market volatility, but an individual security declines into our buy zone, the volatility that's affiliated, directly correlated with the price of these contracts rises considerably. So at the same time that a price comes down to our buy zone, the option contracts grow substantially. And so I gave the real example of BABA. You can all go and do this. It's not a 25% return in 12 months. It's about a 30% return in 24 months. It's not terrible. It's truly quite incredible. And as mentioned, if you consider the underlying business, that's what, most people using these contracts are using them for entirely different purposes. We've inverted the entire thing. Everybody's using a put to just buy it and protect their portfolio. Some institutions are forced to do it, like a life insurance organization that would have an equity portfolio might be forced to buy puts all the time to protect their portfolio and pay out claims. So these are typically used for entirely different purposes. And with a situation like BABA, where they have a portfolio and they have cash, and we're already reducing with our buy price of 70, we're already reducing the cost to about 175 billion for this incredible business. The cost of these operations are now down to $100 billion. So it's just remarkable. I hesitate to say this because I don't want to encourage people to be too active in there with options. But what we have learned something over many years, and that is there are certain cases where the asymmetry in the underlier is so great that we need to do a little something extra because we don't want to miss the opportunity. And I will tell you, we are doing that with BABA. So in addition to selling these puts, we can take a small amount of the premium and we can use it to buy. I like to buy in the money call options because then we aren't quite as dependent on some price in the future, but we actually lock in our current price. We're actually looking at it as a way to build in free call options to our portfolio. So we're selling puts, sometimes even shorter than the 2-year period that I mentioned. We can sell shorter term puts and pick that up and then purchase some in the money long-term calls and lock in a BABA buy at a price far below 90 years from now.
Okay, cool. I've got just a couple more questions. If you're holding your stocks long term, are you not fully invested? If you're selling cash secured puts a year out, then that cash is tied up for 1 year. So what percentage of the portfolio is normally in cash?
Yeah, good question. So, of course, when we move into our infinite compounders, and most of these have been developing over years, that becomes an investment, that becomes an equity holding. But we are currently, we have a 20 million plus portfolio, and we have about 3 million that's sitting around in cash, between 3 and 4 million. And so that's a really healthy number. Now that we have the structured dividend capture process going, it's quite attractive because historically, if we were to take in a large check, say a $5 million check comes in, that can be a weight on the portfolio for existing LPs if it's just sitting around earning nothing. But we now put that to work immediately. So the observation from this question is quite correct. We hold the collateral and the cash to purchase the securities. So we do end up with quite a bit of cash, but that excess cash, we are now taking some of that cash and we are using it for short-term periods to just reach in and grab a dividend from a firm like eBay, a firm like Oracle, a firm like US Bank. These firms will exist in 10 years. We are safely going in and just capturing a dividend over a very short period of time with that cash that we hold. So we're really augmenting the yield that we're getting on our cash.